Do you ever feel your eyes glaze over when someone starts talking about financial ratios? Or maybe you get a little nervous when thinking about diving into your business numbers. Don't worry, take a deep breath and relax. We're here to make this easy. That's right, we're going to demystify those numbers and turn them into useful tools that can help you make better decisions for your business. Think of financial ratios like a health checkup for your business. They help you and others like investors or lenders see how healthy your business is, whether it's cash flow or profitability. Why are financial ratios important? Make smarter decisions. They help you understand what your banker looks for when you apply for funding. Spot strengths or weaknesses. Ratios can highlight areas where you're doing great and where you might need improvement. Track progress. Comparing your ratios to industry standards helps you catch any issues before they become serious problems. Ready to get started? Let's dive in. Profitability ratios. Profitability ratios help you to figure out if you're making enough profit from your sales. Let's break down two key ratios. Gross profit percentage, also known as gross profit margin. Gross profit is what's left after you subtract the direct cost of producing your goods or services from your total sales. It is an indication of the basic profitability of your business. It is the profit that is required to pay all the operational costs of your business, and it is therefore very important that close attention is paid to it. The gross profit percentage shows what percentage of your sales is actually converted into gross profits. What is an acceptable gross profit percentage will depend on the type of business you operate. For example, restaurants will tend to operate on a gross profit margin of around 60%, based on food costs of around 40%. Whereas service providers, like consultants, often have high percentages close to 100% because they tend to have little, if any, direct input material costs. Also important is the trend in the margin from one year to the next. A declining gross profit margin suggests that direct material costs are increasing without a similar increase in selling prices, which is problematic. Here's how to calculate it. If your sales are 100,000 Rand and your cost of producing goods is 60,000 Rand, then your gross profit is 40,000 Rand. You then divide your gross profit by your sales and multiply by 100 to get your gross profit percentage. Net profit percentage, also known as net profit margin. Net profit is the profit left after all your operational costs like taxes, rent, and salaries have been paid. It shows your ultimate or final profitability. The net profit percentage shows what percentage of sales is left over in the business after all costs have been paid. Like gross profit margin, what constitutes an acceptable net profit percentage will depend on the industry the business operates in and the year-on-year trend. A declining net profit percentage tends to indicate falling sales or rising costs, either of which is not a good sign. To work out your net profit percentage, divide your net profit by your total sales and multiply by 100. For example, if your net profit is 10,000 Rand from sales of 100,000 Rand, your net profit percentage is 10%. Return on assets, ROA. ROA tells you how efficiently your business uses its assets to make a profit. If you're making 20.5 cents for every Rand of assets, that's a 20.5% ROA. A good ROA can vary by industry. 5 to 10% is decent. Over 10% is considered strong. However, this should also be compared to the industry norm for your business. To calculate your ROA, if your net profit is 7,000 Rand and your total assets are 34,000 Rand, divide your net profit by your total assets and multiply by 100 to get your ROA. Return on equity, ROE. ROE shows how much profit your business is making for every Rand invested by the business owners. If your net profit after tax is 7,000 Rand and your owner's equity is 21,000 Rand, divide 7,000 Rand by 21,000 Rand and multiply by 100 to get an ROE of 33.3%. A higher ROE means your investments are growing, which is great news. A useful comparison to make is to compare the ROE for your business to the interest rate your money will receive on deposit at the bank. If the ROE is the same or less as the bank deposit rate, then it suggests that the owners would be better off keeping their money in the bank than investing in the business. Break-even ratios. The break-even ratio tells you how much you need to sell to cover your costs. Once you hit that point, everything thereafter is profit. To calculate your break-even point, divide your operating expenses by your gross profit margin. For example, if your fixed costs are 30,000 Rand and your gross profit margin is 40%, your break-even point is 75,000 Rand. So, your business needs to generate at least 75,000 Rand in sales in order to be profitable. Liquidity ratios. Let's break down two key ratios that help you understand if you can pay your short-term debts. Current ratio, working capital ratio. This ratio shows if you have enough assets to cover your short-term liabilities. If your current assets are 24,000 Rand and your liabilities are 11,000 Rand, divide your assets by your liabilities to get a ratio of 2.18 to 1. That means you have 2.18 Rand for every 1 Rand of debt, which is a solid balance. It is important to note that this ratio is also important in determining whether your business is solvent. If the ratio is less than 1, meaning that current liabilities exceed current assets, then the business will be deemed to be technically insolvent and the owners would need to fix that ratio, usually by injecting more cash, to either reduce the liabilities or to increase the assets or both, thereby ensuring that current assets are at least equal to or exceeds current liabilities and solvency is restored. Quick ratio, acid test. This ratio is stricter because it doesn't include inventory. It tells you if you can pay your short-term debts without relying on selling stock. If your current assets are 24,000 Rand, your inventory is 20,000 Rand, and your liabilities are 11,000 Rand, subtract the inventory from your assets and divide by your liabilities. This gives you a quick ratio of 0.36 to 1. Debt ratios. Debt ratios help you see if your business can handle long-term debts. One example is the gearing ratio, debt to equity ratio. If your liabilities are 13,000 Rand and your equity is 21,000 Rand, divide your liabilities by your equity to get a gearing ratio of 0.6 to 1 or 60% if expressed as a gearing percentage. This means that the business is funded more by owners than by creditors, which is usually a good sign. However, what is an acceptable gearing ratio or percentage will again depend on the type of business. For example, a service business will tend to operate on a higher gearing ratio than a manufacturing business due to the higher equity required for a manufacturing business. Ultimately, what is important is that your business generates sufficient cash to service its debts. Efficiency ratios. Efficiency ratios help you see how well your business uses its assets and liabilities to generate revenue. Stock turnover. This ratio shows how often you sell your stock. If your cost of sales is 60,000 Rand and your average stock is 35,000 Rand, divide your cost of sales by your stock to get a stock turnover of 1.71 times. An acceptable stock turnover number depends on the type of business. For example, a restaurant will have a higher stock turnover because it's food than, say, a car dealership. Debtor turnover. Debtor turnover shows how quickly you collect money from customers. If your average debtors are 3,000 Rand and your sales are 10,000 Rand, divide your debtors by your sales and multiply by 365 to get 10.95 days. This means on average, you collect payments every 10.95 days. This number should be compared to your terms of trade of the business. If your business sells on 30-day terms, then debtor days should not exceed that. Creditor turnover. Creditor turnover shows how fast you pay your suppliers. If your average creditors are 10,000 Rand and your purchases are 30,000 Rand, divide your creditors by your purchases and multiply by 365. This gives you 121.7 days, meaning you take 121.7 days to pay suppliers. If your creditor turnover number is longer than the terms of credit received from suppliers, then it might be a sign of cash flow problems and the business may come under pressure from creditors to pay. Now that you've got the basics of financial ratios down, you'll be able to use them to make smarter business decisions. These numbers aren't just figures. They're tools to help you stay on track and grow your business. Disclaimer: these examples are simplified for educational purposes. For more details, visit simplybiz.co.za. SimplyBiz, powered by Nedbank, is completely free to all entrepreneurs. Sign up today at simplybiz.co.za.